You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Hey guys, welcome back to yet another episode. Before we get started, Hamish, you know the intro section that we do for the podcast where I say, myself, Brandon, and my buddy Hamish. I got a comment that someone thinks that there's three of us doing this podcast.
Yeah,
I said myself, Brandon, and my buddy Hamish, but I don't know how to say it because I'm trying to introduce who I am as well.
Yeah.
How should I do it differently? I don't know how to do it. Should
Myself,
I be like
Brandon?
It'd be like with my friend Hamish and I'm Brandon. That's probably how I should have done it.
I'm Brand. Yeah, that's I'm Brandon. And this, and yeah, okay, you could do it that way. Yeah, but I've actually had a couple people tell me that as well. Does sound
we got
like
a comment.
that.
It was one of the the top comments on one or two podcasts ago. It's like, I thought there was three of you for the longest time.
Who's this Brandon guy? He never speaks.
No, they know Brandon. They know Hamish. It's the myself person. Who's the myself?
Oh, okay.
the unnamed, the unknown soldier.
Yeah.
Anyway, how you doing, mate?
I'm doing well. Yeah, it's going well. Nothing too much happening in the markets at the moment. I don't know.
Absolutely nothing. Like sometimes it's just the way it works. Sometimes we have very busy weeks in the market. Sometimes we have, weeks that are a bit lighter on in terms of news. Normally I think we have about two full, maybe 3 full pages of notes. And now today it's like barely 2 pages.
Yeah,
but on the positive side, I think that'll give us some time to get through all the Q&A questions that we've got. So we'll see how we go. But there's still some interesting stuff, I guess. Some Tesla news, a little bit of interesting data on mortgage rates going up already, and we'll talk about Michael Burry for a bit. He's back, baby.
He's back.
Did you see that?
No, I haven't seen that.
I'll tell you about it in a bit. UK inflation data, Warren Buffett as well. Big news story with Warren Buffett. Hamish will run us through. So I guess we've still got some stuff. It maybe just might not be the most revolutionary, groundbreaking news you ever heard of, but
You're really selling us short this episode. Come on.
Sorry. I mean, this is going to be the most fantastic podcast episode you've ever listened to.
The greatest episode ever.
Yeah.
In
Worthy
the Young
of a sponsor like
Sharesight. Do you want to do it this week?
No, I just wanted to do some sort of epic segue to get you to just roll seamlessly into it.
It is sponsored by Sharesight. And Sharesight is an application that you can use to track the performance of your stock portfolio. So basically, you can bring in all of your trades, either automatically or manually. So you can connect your broker. So I don't know why I was doing it like that to begin with, but either automatically, you can connect your broker. Most brokers work with Sharesight, or you can download all of your trades from your broker using Excel and just manually enter them in. And it will track all of the different types of holdings, so capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies, that's an important one at the moment. With changing interest rates and all of these things going on in the markets, inflation, there's a lot of fluctuation going on in currency. So make sure you're tracking that if you're buying shares internationally. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used to track the performance of your portfolio and used at tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. Use that link, sign up to a free plan, track up to 10 holdings for as long as you want, or you can sign up to a paid plan and get 4 months free when you use that link. So go check it out. And thanks to everyone who's been using that and supporting the podcast.
Tell you one thing, Hamish, I'm getting so excited for our trip to the United States.
Yeah, we're getting there. We're getting organized.
It's getting closer. It's actually not that far away.
What's the date today? Yeah, okay. Late
24th. Yeah. So it's like a month away. We're going to be leaving to the US.
Yeah, there's actually quite a few things to organize.
Yeah,
and
that's true.
I'm not the best at organizing things, so we'll
You need to
hopefully-
get that. Did you fill out that form I sent you yesterday?
Yeah.
Okay, cool.
Yeah.
Yeah, we need to figure out bank cards. We need to figure out
Yep.
the rest of our accommodation and flights.
Yeah.
We need to figure out how we're going to get that giant inflatable Mickey Mouse back to Australia, the one
God.
we're going to buy at Disneyland.
Yeah. That's
going to be tricky.
Figure that out.
Well, maybe we'll see how we go at the end. We can talk a little bit more about our trip maybe at the end. But let's. Where do you want to begin?
Yeah,
Oh,
I
do you
don't
want to?
know.
Can you talk us through what's going on with this Warren Buffett thing? I think that's pretty
Yeah.
decent news this week.
Yeah, so Buffett finally he's put some money to work, and he's kind of made some little investments here and there. We've of course seen some smaller stock market investments that Berkshire has made, but maybe not Warren Buffett actively making those decisions. And he's made some acquisitions of some assets. What were the assets? The oil pipe assets that he bought a couple of years ago as well. So he's done some things here and there, but this is one of the most, well, it is the largest acquisition he's done in, I think it was 6 years. Yeah, Berkshire's biggest acquisition in 6 years. So he acquired another insurance company, so very on brand for Warren Buffett and Berkshire Hathaway. The company is Allegheny.
Allegedly.
Allegedly. I don't know how to pronounce it. Allegheny, I think. I don't know. I went on I was listening to some CNBC to try and I listened to a couple of news places to see how they pronounce it.
I do that as well.
And there was different pronunciations on different ones. So I think
Right.
nobody knows how to pronounce the name of this company. So we'll go with
Right. It's got to be either Allegheny or Allegheny.
Yeah, Allegheny was what, or Allegheny, I think. I don't know. I guess.
Oh,
this would be-
Allegheny, yeah.
Allegheny. That's okay. There's quite a few. Could be. Yeah, I don't know.
Yeah.
We'll never know. All right.
This will be like, when in financial reports, if they're going to refer to something differently from now on, they put it in brackets. We'll put it in brackets from here on, referred to as the insurance company.
Yeah. the acquired.
So we don't have to
insurance
say the
company.
name again.
Yeah.
We
No.
just say
So
the insurance company.
big acquisition, $11.6 billion. So a lot of money going into this acquisition. So the company is a New York based insurance company. It's involved in a number of different insurance businesses. So it has a number of subsidiaries. It does wholesale, specialty, property and casualty, and reinsurance. And they're also a conglomerate, just like Berkshire, owning a steel company, a toy maker, a funeral services firm, along with its primary insurance business. So actually it does quite a few different things beyond insurance. So yeah, very interesting. Of course, insurance business fits right alongside, I think, probably one of the largest parts of Berkshire's business, being the different insurance companies that they own. And Buffett actually said that he's been observing this company for 60 years. That's,
Oh, gosh.
so that's next level patience, right?
Yeah, I reckon.
How long did he wait on Coca-Cola? I think he spoke about when was Buffett born? In the 30s, I think, right? Late 30s? Or
No. I'll have a look real quick. He was born, 30th of August, 1930.
1930, yeah, because I remember he spoke about when he did make the Coca-Cola acquisition, how of course he was counting all of the bottle caps when he was a kid, doing delivery runs and figuring out which one was the most popular. And even back then, he'd identified Coca-Cola as being the outstanding one. And it took him, whatever it was, 30, 40 years or something to eventually put money into the stock. But 60 years is quite a time to wait for the...
Yeah, I reckon.
Time to put money in.
Ultra patient. Does that mean that this business has been garbage for the last 60 years?
Yeah, I wonder, yeah.
Or maybe it's just been overpriced for the last 60 years. It's taken him 60 years to finally pull the trigger and go, you know what? I want it.
Yeah, now's the time. Yeah, that's crazy. Yeah. I mean, 60 years is a long time for a company to be around. So
Yeah, I reckon.
I think it's likely
It's probably pretty solid.
Yeah, it must be pretty solid. No, I don't know. I mean, I've never looked at a company for with a 60-year track record before. I guess there's lots of ups and downs. I guess it's had some boom periods and then it's dropped off and become a smaller company and then risen back up. I don't know. But the company is doing well at the moment. The last 10 years, its revenue has doubled from 3.7 billion to 7 billion.
Right.
Profit has been much more cyclical, although it's always positive. So it's not going from a high profitability to losses in some years. It seems even in the years where there's a lot of claims, it still remains positive, which is obviously something that Buffett and value investors look for, consistently profitable businesses. Buffett's it reached $1 billion in profit in 2021. So that gave the transaction about a PE, price to earnings ratio of 12. So.
Oh, okay. So not bad, I guess.
Yeah, not bad.
Seems cheap. I don't know anything about it, but seems like a Buffett kind of investment.
Yeah. Yeah.
Well, it seems exactly like a Buffett investment. I think if you just said, if Buffett is going to buy, if you could describe the company that Buffett would like to buy the most, you would probably say, it's probably a very cheap insurance company that's doing very well.
Yeah, exactly right.
That's probably what you say, right?
Yeah, no, exactly. No, so very interesting. Buffett on the deal. He didn't say too much about this. He said it represents a multiple of 1.26 times Allegheny's book value.
The insurance company.
Yeah, no, I should have said that. The insurance company. But the transaction is still a fraction of the $150+ billion cash pile that Berkshire currently holds. So biggest acquisition in 6 years, but still sitting on a lot of cash. And go on.
But it does make sense. I mean, there's not that many businesses that you could acquire that around that. And that's what we've been saying with Warren Buffett. He's come out and said, look, I'm trying to put, $10 to $20 billion into these things at a time. So it does seem very consistent with what he's said he's been trying to do. So clearly now he's just gotten an opportunity. Of course, we've discussed at length of how he doesn't actually have that many opportunities full stop, even in really cheap market conditions. He doesn't have that many opportunities. So I think he's just been he's seen something that's what does he say, it's the perfect pitch that's right in your zone, and he's just swung at it and he's given it a smack.
He's certainly waiting. He's certainly waiting on it.
He's waiting. Yeah, he's let a lot pass through to the keeper.
Yeah. Did you see? This is just reminding me a couple of weeks ago. AMC's smart acquisition in the cinema industry. Did you see that?
No. What happened there?
So AMC, of course, is one of the high flying meme companies. They made an acquisition, which I'm not sure quite makes a whole lot of sense. They bought 22% of a gold mining company.
What? Gold mining company?
Yeah. So it's a little bit
so
strange.
Bizarre.
I haven't looked this up, so I don't really have anything to say on this. But I just remember seeing this a couple of weeks ago and just thinking, what the hell is AMC doing? And I wonder, it's
AMC
yeah
is still up 129% over the past year.
Yeah, I don't understand it.
It's still down substantially from the peak of its short squeeze. It's down 66%.
Wow.
So that just shows you how high it did go when it was squeezed. But that's crazy. Gold miner.
Trying to see.
Struck gold with its investment in Highcroft Mining.
There you go.
Yeah, I don't know. What's the play there? Do they want? I don't know. They want to get some exposure to gold. Do they go run with the kind of theory that gold is a safer asset in unstable times? So why not? Let's just buy a gold miner, so we have a cash producing asset that produces. I don't know.
It is very strange. I really don't understand it.
I would ask a lot of questions to the CEO of why they did that.
Yeah, I'm trying to find if the CEO made a statement about why this makes any sense, but
Because in terms of you kind of some businesses, they make acquisitions, like Tesla, they acquire Maxwell Technologies, which is about dry coating, dry electrode technology, and you're like, okay, that makes sense. And then you look at stuff like this, which is like cinema, gold miner.
Yeah.
I don't get it.
Anyway.
That doesn't make a lot of sense to me. Anyway. Whatever.
Ridiculous.
We're drifting a little bit. Is that all we had to talk about for
That's
Warren
pretty much
Buffett?
it. Yeah, I tried to have a look at the company a little bit. There wasn't anything particularly interesting that stood out to me. It's an insurance company and it's a conglomerate. That's basically it.
That is a kind of strange collection. What did you say they had? They've
They've got a steel company, a toy
steel,
maker,
toy,
and
funeral services. Yeah, it's a bit weird, isn't it? But
Yeah.
there you go. There you go. Good luck to you, Warren Buffett. I still want to start a restaurant chain called Warren's Buffet.
Warren's Buffet.
Yeah, that's my goal in life. Once all this YouTube stuff is said and done, I'm just gonna retire and start Warren's Buffet.
Yeah, that's great. Do you reckon you're allowed to do that? Do we have to get permission from?
Nah, it's spelled differently.
It's spelled
Buffet's
differently?
one T.
I know it is,
think.
but
Yeah.
okay, all right,
Nah, I just run with it.
okay.
I'll change my name to Warren to make it more believable. Anyway, all right, let's move on.
All right,
What should we talk about? Berlin Gigafactory. Bit of Tesla news. The Berlin factory is now open for business. Hamish Hodder. Did you see this during the week?
No, I did not.
It was interesting. A few weeks ago, they got a permit or a conditional building permit to say, yes, all right, it's your building stuff's approved, but they had about 400 conditions that they needed to fulfill in order to actually get their full permit, which is a bit strange.
Wow.
And Tesla said that it planned to cover all of them within the next 2 weeks, but some of them are like things that you can't do within 2 weeks. It's like you need to gather advice and feedback from the community or something like that. Yeah. So, luckily though for them, and this has been like all of their factory, like they're building them really quickly, and the one in China, they built it, bang, done, start delivery, all good. This one has just been so caught up in red tape, it's been unbelievable. But it finally does look like that they are able to start producing vehicles at the Berlin Gigafactory. They didn't satisfy all of the conditions yet. However, they kind of fine-tooth combed it and they found what ones were actually stopping them from starting to produce cars specifically. Like I think in terms of the factory, there's a lot of things they have to fix, but in terms of actually being licensed or permitted to build cars, there was only a few they needed to tick off.
Okay.
So anyway, they did that, and Elon Musk traveled to the factory and held just the other night, actually, he held a delivery event for the first 30 customer cars out of the Berlin Gigafactory. So they're now going to start the process of ramping up. And overall, the factory has a permit for a 500,000 unit per year production rate.
Wow.
And, and also has a number of other production processes approved, including battery cell production. However, that's going to be coming a little bit later in the piece because the cell plant's still under construction. It's adjacent to the main factory. But,
Wow.
here we go. Things starting to ramp up. They got a few gigafactories coming online this year, and it starts right now.
Yeah, this will be a big year to kind of see how Tesla continues to perform, because last year was insanely high for the number of units they delivered, much higher than the year before. 1 million, right? And the year before that was 500,000 or something like that. Mm-hmm. So this will be massive to kind of see how this is going. Have we had any quarterly data from Tesla this year so far, like 2022? Not yet. So we're still waiting.
Not yet.
They don't do any crazy quarterly. They just do the normal.
As soon we'll get the production delivery numbers pretty much as soon as the calendar quarter finishes.
Okay. All right.
So they release that data straight away,
Yeah.
and then we'll wait for the financials to get processed and audited and stuff, and come through during earnings season. So,
yeah. Okay. Yeah. Well, that'll be interesting. So next week we'll get a bit of access to that, but it'll be a test over the next year or so, I guess, with this inflationary environment. If we're going to see high interest rates, the auto industry is an area that tends to get hit quite hard, particularly luxury auto. It kind of combines two things that people tend to cut, which is discretionary purchases or luxury purchases, and purchases that are made with financing, with interest, where there's an interest payment attached to it. So Tesla, for the most part, I guess, I don't know, maybe you disagree with this, but I would say they, for the most part, sit towards the luxury end. It's not a cheap car, right? So
no.
Even in the United States. So it would be interesting to kind of see how they handle that and what that means for their business. They're in a pretty strong financial health position at the moment.
What I'm really interested in is, I agree with you how, we hit tougher economic times, people's disposable income dries up, auto sales are hit generally.
Yeah.
I think that this is going to be an interesting test of, of a competitive advantage, because we know that Tesla has quite a backlog of orders that they need to fulfill.
Right.
So it will be interesting because this year you've got tougher economic conditions for people to borrow money. So for things like expensive electric vehicles.
Yeah.
You've also got two big factories, new factories coming online. The one in Berlin, the one in Texas. So I think this is going to be a really interesting test whether they will still have that same level of production and demand and delivery this year when you've got a huge increase in supply, and you've also got the tougher economic factors, because we know what the factories are capable of producing.
Yeah.
So you can just factor it in. Okay, this factory is producing this many per year. That factory can produce this many per year. And if you add them together, and that's the amount of deliveries that they are doing every year, then you're like, okay, so they do have a moat, tougher economic conditions, but they're still selling all of their possible output.
Yeah. Do we know what that is? What the?
Yeah, I don't know it off the top of my head, but I could maybe come back next week and give that number. But
because they have a couple going now. How many factories do they have?
Yeah, Fremont, Shanghai, Berlin is now coming up online, and then Texas is coming online now as well with the Model Y.
Okay, right. Okay, so
they actually report I won't do it now because it'll probably take me too long.
Yeah,
but in their reporting, they actually show what each factory is expected to produce.
Yeah, well, that'll be interesting to see if they continue to max out. Max out their capacity. It'll be interesting. The other kind of offset to that is that the increases in oil prices at the moment are not affecting Tesla owners, or it's not a de-incentive to go and buy a new vehicle. Although I guess maybe that doesn't factor in too much because
it might even be an incentive.
Exactly.
Some people might want to switch away from petrol cars.
Yeah, exactly. If people believe that these higher oil prices will be sustained for a long time, then it could definitely be an incentive. So interesting to kind of see how that plays out. Yeah.
Yeah. Yeah. But that's pretty much all I had to say. Not a huge amount of news there.
Yeah.
One other tidbit is that Tesla revealed they've already hired 3,000 workers at the plant. So definitely providing a lot of jobs in that area, which is kind of surprising because, man, the one thing that's baffled me is that a lot of this red tape that's been raised has been from environmental groups fighting against Tesla.
That makes no sense.
What? It's like, guys, look at what this company is doing. Have you never looked into this company before? Are you serious right now? Environmental groups literally trying to stop them from building this plant in Berlin. I'm like, man, that just doesn't make much sense to me. But there you go.
I guess they don't want a new factory or more factories kind of thing. But it is kind of backwards, because the idea is, of course, there has to be new ones to replace the old technology, which is far worse for the environment. So
kind of like a case of the greater good,
Yeah, it's not going
to cheer for the greater good. It's
not like Tesla is just going to buy a current combustion engine factory and then convert it into. That's not how that doesn't make any sense. Of course, they have to build it completely their own factory, and the other one has to die. That's just unfortunately, that's just the nature of capitalism. But and then maybe at some point in the future, when those businesses are not doing well, they can sell those factories for scraps, and then they can be converted. But we're just not at that stage yet. We're at the stage where businesses need to build their own infrastructure to compete. So it'll be interesting. I did have something on inflation.
Tell me.
Yeah, so we get...
Of course, the inflation, man.
It never goes away.
That's going to be your superhero name.
I love inflation. I mean, I don't love inflation. I love talking about inflation.
I was going to say, you want to revise that statement?
I love inflation. Inflation's great. Hot take.
You find it interesting.
I find it interesting,
to research the dynamics of inflation.
I do, correct.
Is that a better way to say it?
Do you want to just do my segment? No, so the UK inflation numbers came out 6.2%, higher than the 5.9% expected. So UK is getting up there. The month-over-month increase was actually 0.8%. So they're step for step with the US now. US's yearly inflation is significantly higher, but on a month-by-month basis, they're now pretty much in line. I think the US was 0.8% last month as well. So they're matching pace, which is kind of interesting. One other thing that I thought I found curious was the UK has already raised their rates to 0.75% prior to this last month. So clearly, with their rates continuing to, or their inflation continuing to expand at a high rate, they're going to need to continue to raise interest rates at least well above 0.75%. And that's kind of interesting because I think the Fed is aiming for, I think 0.5 to 0.75 by the end of the year, or maybe it's 0.75 to 1 by the end of the year. So it's just interesting to see a different region or a different country and see that they already have interest rates at that level and inflation is still running away. And I think it goes into the point that you were saying a couple of weeks ago or last week that in the past, when inflation has been this high, we've needed much more dramatic interest rate increases. So it's yet to be seen if we're going to need that or not. But yeah, that's all I had on UK inflation. All right.
Well, I'll take over from you then, because that's interesting that you're kind of revisiting that example. Is that Michael Burry, our mate, he popped back on Twitter for one night only, for one tweet only.
Wait, he's gone again?
Yeah, he's gone again. You can look up Michael Burry archive if you want to see it. But he came in for one tweet just out of the blue. And have you found it?
Yeah.
So for those following along at home, he posted a picture of himself as a kid with the caption 1977 says hello. And of course, if somebody posts that, one of your friends posts that, you just think, they're just posting a photo of them as a kid, that's nice, whoop-de-doo. But no, people online were very quick to speculate
conspiracy.
That Michael Burry is essentially saying that what we face now is essentially the same scenario of what we were facing around 1977. And running with that theory, I kind of just looked up what inflation was at the time, what was happening with interest rates. And at the time, inflation was at 6.5%. Ooh. And it was on its way up. Eventually it got to 15%.
But it came down by itself, right? It was transitory.
Oh, yeah, 100% transitory. You're exactly right, Hamish. But interestingly, rates were a little bit higher at the time. They were on their way up as well. So rates were 4.6%. And they rose. The Fed funds rate rose to 6.5. During 1977, it started at 4.6%, rose to 6.5%, on its way up to 20%.
That's insane. Yeah, it is kind of crazy to see. Sorry to cut you off. It's just
no.
It is just crazy to see the monetary policy today of we'll do 4 rate increase or whatever it is, 6 rate increases of 0.25. Back then they're doing like 1-2% a year. Then they jacked it up 15%. It doesn't work.
Yeah, exactly right.
I just can't imagine. I don't know. Could it be? I mean, Ray Dalio always talks about using history as an indicator, and is it really all that different? Is 0.75 really going to work?
Yeah. Another rate, cha-ching. Another rate hike, cha-ching. Another one, cha-ching. It's like we're going up and up and up. But I was going to say something and then I forgot what I was going to say. So there you go. But it's very consistent with what Michael Burry's been talking about over the last year or two, really.
Yeah.
In fact, he was saying, and people always say, Michael Burry never gets things right anymore. He was calling out this inflation, this potential for steep inflation, when the inflation rate in the United States was at 1.5%.
Right.
The annual inflation rate. So he called it before any of this happened.
Yeah.
So
it's early again.
He's pretty good analytically. He can definitely I guess no one knows exactly what's going to come, but he's pretty good at putting 2 and 2 together with the different dynamics that he's seeing.
Yeah.
But yeah, there you go. So that's today's segment on inflation.
So that was a couple of weeks ago he posted that, right? I think March.
Yeah, I think so. I think I only
10.
just saw it in the last little while.
Damn. Hopefully, usually he posts in batches. As if he just posted the one and kind of just left again. He actually didn't delete this one either. It's still there.
Oh, is it?
Yeah.
You know, how funny is that? I had no idea it was still there because I just automatically go to the archive.
Yeah, well, you don't want to miss any.
Look.
Yeah, I mean, you have a good chance you're going to miss a bunch if you go directly to his Twitter.
That's true.
So it is kind of, I mean, we've spoken about this, but it is kind of weird. Like, what's even the point? The archive exists. He may as well make the archive his own, so he owns the post kind of thing. Yeah. I don't know. It's just,
I don't know either. Maybe it's just to be a little bit more cryptic or something. I don't know.
Yeah, maybe just having fun.
What should we talk about next? Do you want to talk about mortgage rates?
Do I want to talk about mortgage rates?
No, do you want me to? I mean, you can talk about them if you want.
Mortgages. We love them. We hate them. Go ahead. What's happening with mortgage rates?
Well, I don't really know too much, but I just saw this CNBC article pop up, which I thought was quite interesting, that mortgage rates are surging faster than expected in the United States at the moment. So it says the average rate on the popular 30-year fixed mortgage. First of all, 30-year fixed mortgage.
Yeah, why don't we have those? No.
Do we have any sort of product like that?
No. I think the highest fixed rate you can get is like 4 or 5 years on a 30-year mortgage or something like that. I don't know.
That's been my experience as well.
No. That's a very American thing. Yeah.
If you could get a fixed 30-year mortgage at 4.7%, do you reckon you'd take it?
Yeah, I'd get 6 of them.
I reckon I'd get 6 of them as well. As long as you can balance it with your income.
That is an insanely, anything below, I feel like, well, especially, I mean, over the past couple of years in the US, they've been below 4%, those 30-year fixed. So anything in that range is insane. Yeah. For 30 years, that is crazy.
Yeah. For those that are like sitting like us here in Australia, it also goes to explain why you've seen such a surge in like house prices. Because if you're an American and you've got that opportunity to lock in 30-year fixed at like 4%, you just be like, yep, I'll buy it. Like everyone's thinking that. Yep, I'll buy that too. I'll buy that as well. Lock it down. So it's pretty interesting. But anyway, back to the story. Average rate on the popular 30-year fixed mortgage hit 4.72% on Tuesday, moving 26 basis points higher since just Friday, according to Mortgage News Daily. As a result of this recent spike in rates, economists are now lowering their home sales forecasts for this year. Most estimates at the end of last year had the average 30-year mortgage rate hitting 4.5% by the close of 2022, but the war in Ukraine, rising oil prices and inflation have all lit a fire under interest rates. This time in 2021, rates were about 3.45%.
That's crazy.
Wow. So it's gone up by at least a full percentage point and a little bit more. A shift in the policy outlook from the Federal Reserve suggesting far more rate increases than expected is pushing bond yields higher. The 30-year fixed mortgage loosely follows the yield on the 10-year US Treasury, which is now at the highest level since May 2019.
Loosely is the correct terminology there, because I don't think
they're quite the same thing.
I don't think it's moved really at all, the 30-year US bond yield. I'll have a look, but
it was the 10-year US yield they linked it to.
Oh, was it 10-year?
Yeah, but I don't know. Yeah, okay. I'm just reading what the article said.
Oh, yeah, well, the 10-year's moved a little bit.
Sorry, it did move a little bit?
The 10-year has moved a little bit. It's at 2.3% now.
Yeah.
So, yeah.
Says the rise in rates comes on top of an already sizzling housing market. Demand remains strong and supply remains historically low. This has pressured home prices, which are already up 19% in January year over year. It's the latest read from CoreLogic. Yeah, I find it an interesting thought that, as rates start to rise, that property investors may actually move to take on more mortgages. I mean, I think in the back of my mind, I just think that, as rates rise, that just means, that probably just means more defaults from people that overextend themselves, and then more inventory comes onto the market. But I never really took the time to think, well, actually, if you're starting to see rates rise and you've got like this fixed 30-year mortgage, that maybe you should actually move now. So it might actually create, if people think that rates are going to keep going up, it might create this increased demand where people just want to lock everything in before things get worse. I never really thought about it like that, but it does make sense in a way.
Yeah, it would create kind of like a last bit of frenzy, like the last bit of excitement before the banks stop accepting loans at those insanely low rates, or as they start to increase them. And then eventually, I guess they reach a point where people can't afford the payments. So interesting.
Yeah, so you probably might, you see like an increase in demand as rates start to tick up. You might see an increase in demand up to a point where then the dynamic flips. But
it is interesting. The property market is a fascinating one because you have this added dynamic of just people living in housing. It's not a pure investment. You have this entire aspect of the market where people, how popular an area is impacts the price of the asset of the house. So you kind of have this, at least at the moment, at least in the US and Australia in particular, you have this consistent influx of population from particularly overseas, let's say. You have this huge population influx, which is just a constant pressure on the demand side, especially in major cities like Melbourne and Sydney. So you just have consistent demand. So even if there was an increase in interest rates in the stock market where it's more of a pure economic environment, it's much more likely to be seen with lower prices of stocks, whereas that may not necessarily be the case in the property market because there's this other element of people just moving to Australia, not necessarily on investment, but just to live here because it's a better place to live than certain other places.
Yeah, so many individual market dynamics to each asset class that it does make it, I think that maybe even I'm guilty of this. We make comparisons between two markets like way too easily when there are a lot more factors at play. But that's all I had to talk about for mortgages. And that's like pretty much all of the news that's going down this week, besides obviously the very sad news of continuing conflict from Russia's invasion of the Ukraine, which, sorry, I shouldn't say the Ukraine. I keep saying that.
I say that too. What?
Yeah.
Where did that come from?
But it's incorrect. It is incorrect. So I got to try to stop saying it. Don't say the Ukraine. Just say Ukraine. Russia's invasion of Ukraine.
Yeah, I wonder where that came from because
I don't know.
That's what I do as well. I don't know. Not sure.
I don't know either. But not politically correct. Well, just not correct. Full stop.
Yeah.
So,
okay.
But anyway, with that said, should we do some Q&A? We've still got 20 minutes or so.
Yeah, we've got a few questions here. Where should we begin? I'll give one to you. You want that one?
Send it my way.
Liked your comments.
I mean, we're going to talk about all of them. So.
Oh, are we? Okay, cool. Liked your comments.
I imagine so.
Yeah, true. Like your comments about oil moving in the direction of being a legacy commodity, or at least not as crucial as in the past. What are some emerging sectors or businesses in the EV space that are not named Tesla?
Yeah. I do have to say that I really like my brain. This one was asked a couple of weeks ago, and my brain, I feel as though I've already answered it in the podcast. I did scrub through the last couple of podcasts just to make sure I hadn't answered it, and I didn't hear myself answer it in those podcasts. So if I'm essentially going to repeat what I've already said on a previous podcast, I do apologize. But Hamish, you are adamant that I haven't answered this question.
I'm 95% sure we haven't answered this question. So I'm curious if anyone's heard us. If anyone remembers this, let us know in the comments, because it's funny that you are so confident that we have, and I'm pretty confident we have it.
But it's like maybe because I have written just a couple of notes here to answer this question well. So maybe it was me writing down that made me think that I've already answered it. So I don't know. Anyway, apologies if I'm repeating what I've already said. But when it comes to EVs, I think a lot of people are just looking at the, stitching the car together, the actual car manufacturer. But I think that one of the main things to look at in terms of EVs is the battery side of things. So I think that a lot of innovation, like Tesla's leading the way with like autonomous driving, but I think when it comes just specifically to EVs, the biggest thing you can look at is the battery pack. It's the most, it's the bulkiest part of the car. It is where most of the money of the car is. Like when you pay that premium for an electric vehicle, the main reason why it's at a premium is because of that battery pack. So I think that there's going to be a lot of companies in the future that are focused on batteries. Not that there aren't already, but I think there's going to be even more, because it's like a fundamental building block of the future energy system is the battery cell.
Yeah.
So I think that there's going to be a lot of companies trying to do different things with batteries, trying to mass manufacture lithium-ion batteries. I think that's a big business of the future.
Yeah.
And I also think if you think about the transition to the global fleet of electric vehicles, another big thing is, or another big company of the potential big industry of the future is battery recycling. Because at the moment we really don't have to, there's not that many batteries to recycle. Like, yes, we've got batteries in electronic devices, but they're very small batteries. Yes, there are a lot of electronic devices, but they're all extremely small batteries.
Yeah.
So if we get to a point where every year there's millions and millions and millions of car batteries that are being recycled, battery packs that are being recycled, that's a big problem, because it needs to be, first of all, it needs to be handled in an environmentally friendly way, but it's also a potential big source of cash generation, because it's a cheaper method to accessing those those raw materials than mining. So if you when a battery pack is depleted, it's not like there's any less lithium in the pack. So as long as you can break it apart and just extract the lithium back out of the pack, then that's just, you've already got lithium in its mined state, in its refined state. So it's actually economically advantageous if you can get those minerals out without having to do any mining. So
wow, there you go.
Sorry, long-winded answer, but that's the sort of stuff that I find really interesting.
Yeah, interesting point on the need for batteries, not just in directly in vehicles, but of course just energy storage, large
grid
battery
storage.
Grid storage, the ones in South Australia, because that is kind of one of the limit, not just a limitation, I guess, of clean energy, but just a limitation of energy in general, is that it's not easily stored, right? I'm not an expert or anything, but that's my understanding of it. So if we can nail that, then of course grids can become much more efficient at using electricity. So yeah, very interesting stuff, but
yeah,
well outside my area of competence.
All right, well, let me ask you about this one. How can you explain the constant reduction in book value that we see at Apple in the last decade? How does this sit with the love Warren has? Wait, WF?
I don't know. Is it a typo?
I just saw that. How does that sit with the love WF?
Who's WF?
Did I copy paste that incorrectly?
I don't know. We'll just assume it's Warren Buffett, right? We'll assume it's Warren Buffett. Not that it matters really to the question.
No,
anyway,
no.
So the question's about the reduction in book value from Apple. And this kind of applies to a lot of companies, especially over the last 5 years. A lot of companies have done what Apple has done, which has resulted in equity on their balance sheet or book value going down, which is aggressive share repurchases. So they're spending a lot of money, not only of the profits that the business is producing, but the cash that's on the balance sheet. And when a business uses cash, or this is probably a better way to think about it, when a business delivers more cash to shareholders than it produces, so it uses its profits, but also profits that are coming in, but also uses some of the cash on the balance sheet or takes on some liabilities, then equity goes down. And it's not necessarily a good or a bad thing, which is something that you've heard. If you read through some of Warren Buffett's letters and some of his interviews, his philosophy on book value has changed over time. He typically exclusively looked for companies that had consistently increasing book value. And that's generally what you want to look for. But that principle, I guess, made a lot more sense when share repurchases wasn't all the rage, which is what it is at the moment. The last decade in particular, instead of paying dividends, companies just do huge, ridiculous amounts of share repurchases. So then the question just comes, is it good or bad for the company? And that question really comes down to whether the shares are being bought back by the company below what those shares are worth. So less than the amount of cash that can be delivered to shareholders over time. So the way I like to think about it I just like to think of when a company repurchases shares, and this isn't perfect. This is an approximate way to think about it, but think of it the same way as if you personally were buying more stock. Because if you think about it, when you personally buy more stock, let's say you own some Apple, but you want to buy some more, what happens? Well, the cash in your bank account goes down and your percentage ownership in the company goes up. So you own more of the stock and you have less cash. And pretty much the same thing happens to the company that repurchases their own stock. The cash in their bank account goes down. And if you owned the whole company, which is a way of thinking about it, which is kind of a weird thing to think about when we're talking about share repurchases, but if you owned the whole company, you can think of that cash on the balance sheet as yours in a way. Then cash goes down. And because there's less shares available, percentage ownership for you has gone up. So in that respect, you should think of it the same way as if you were personally buying the stock. Is the stock undervalued? So that's how you can make a determination. But the reason why book value goes down is because you're seeing you're only seeing the first part of the equation, which is that they're paying for the shares. So the cash is going down because they're buying the shares. You're not seeing the increase in value that has been gained from each share getting a little bit bigger. And that's something that comes over time in the same way that when you buy a share, of course you do get the share. I guess technically you could think of that as book value, but you pay the share and then over time it delivers you cash flow. So that's kind of how that works.
I think the way I just sum it up is I call share repurchases like an invisible investment.
Yeah.
Yeah.
That's a good
which
way.
it definitely does help shareholders, but in terms of looking at financial statement, I mean, of course you can see share repurchases on financial statements, but it does look like it's, if you look at a 13F, you won't see it, but it is definitely helping you, even though, it actually looks like you could be like, whoa, what the heck? Equity's gone down.
Yep.
That's bad. But no, it is helping you out.
Yeah, and in particular, you want to look for companies where the management team, a new CEO comes in for just 3 years and he changes the compensation plan to benefit himself, and then he does aggressive share repurchases. That's the best situation possible, and using debt. So that's what we want to look. You want to look out for that.
What was that guy's name we were talking about last week?
I don't know, Kevin Johnson. Yeah,
Kevin Johnson
retired for the second time in a decade.
Yeah. Kev. On you, Kev. All right. Should we do...
Yeah, where do you want to go from here?
We'll just do this last one. Oh, actually, we'll do this one because that's...
Yeah, okay. Hey, guys, what actually happens to shareholders if a company they're invested in is delisted? Example, Bubba, delisting.
Yeah. I don't actually know specifically like what happens to... I know that the shares are just traded over the counter. But I don't actually know how that relates to like voting and doing that sort of stuff and share registries and that sort of thing. I actually just don't know. I would need to go in depth. But it's like it's not great if a company gets delisted. You can basically guarantee that stock price is going down. However, having said that, it's not the end of the world. Like you will still be able to buy and sell shares just over the counter. The issue might be is whether especially if you're international, is whether the broker that you bought the shares through is able to offer share trading, over the counter share trading.
Right.
Which might be a problem if, like, for us buying Barber shares in the States using a international brokerage account, we'd have to check that. Yeah. But yeah, it's not the best, but it's also not the worst. Yeah, is how I describe it. But I don't actually know the ins and outs. That's something I would need to do a lot of digging on. Yeah.
Yeah, I don't think I have anything kind of to add on that. It's one of those things I certainly don't understand how it works, and I think for me at least that's one element of why I've decided not to invest heavily in Alibaba, just because it's something that's complex and I'm not quite sure what would happen if that was the situation.
All right. Hi guys, love the show, the vibe, the energy, everything. Thank you.
Thank you.
Long-time fan from Spain. Cool. I want to go to Spain. You ever been to Spain?
No, that would be great.
That'd be so cool. I just feel like Spain's one of those places where you'd just be like a non-stop party.
Yeah.
I mean, that's probably
that.
not what Spain's like, but that's definitely the vibe I get from what I see through media. But anyway, of course, the question: where would you guys set the line for not continuing to average down in a company that you have huge convictions in?
That's a good question, actually. I think for me personally, I have a limit of about probably putting about 20% of my portfolio in a single business.
Fair.
So that's probably where I would draw the line. But with that said, if a stock, let's say, gets within my range and I build it up to 20% in my portfolio, if it falls another 50%, assuming the rest of the portfolio hasn't fallen that far, it will be a smaller percentage than 20%. So there will now be room.
Genius.
There's now more room to build it back up. So that's something to keep in mind. So like
that you look at like your in and your buy prices, and it's like, Hamish, you've invested $1 million or 900,000 was used to buy Alibaba, and it represents 1% of your portfolio. That means I could buy more.
Yes, exactly right. Yeah, no, but so 20%, and I think I think for everyone this is going to be different, depending on your conviction in the business and your experience investing, whatever it is. For some people, it might be, I don't know, 5, maybe 10% you're willing to put into an individual business, or maybe it's nothing. Maybe you just invest in index funds, or you're Warren Buffett and you put 70% into American Express because you're crazy. I don't know.
Bad fool.
So yeah, I think
it's just individual, isn't it?
I think it's individual. Yeah.
It's not one size fits all. But I probably agree with you that around 20% feels about fair.
Yeah.
Because, I mean, for me, I just think, look, I still, I feel like I'm getting a handle on investing, but I'm certainly no Warren Buffett. That's for damn sure. I could still be making a mistake. And if I have made a critical error, how much is that going to hurt me?
Yeah.
So I think if you're like, I've got huge conviction, you might think that you've got this one nailed, it's in the bag, but I just feel like having that approach is almost at one point in your life a recipe for disaster at some point, because you've always got to imagine there could be something, even if you haven't thought about it yet, even if it doesn't even exist yet, there could be something that sinks your battleship. So I feel like, a little bit of diversification
goes
for
a
me
long way.
is quite nice, and it makes you sleep better at night too.
Yeah. I mean, Buffett was kind of insane putting 70% in American Express, because I believe the reason why it got cheap for the first time was I believe there was fraud going on in the management team. So very, very risky, I guess. There was a lot of uncertainty, I guess is the right way to say, about the future of the business, based on the fact that there was corruption going on within the management team. I don't know if I would ever see that happen in a company and think, let's go all in on this stock. That's some conviction. But I don't think he had 70% in it for all that long, so it wasn't anything too crazy. But yeah, very interesting. I mean, Munger is heavily concentrated. I mean, what is he? Actually, I guess not as much, but he only has a handful of
he's
stocks.
got like 3 big bets, I think.
Yeah, 3 big bets. And then, people like Nick Sleep I think he had like 80% of his portfolio in Amazon at one point, but that was just because it had increased. It wasn't necessarily because he put a lot of money into it in the first place. It just did insanely well. But yeah.
And I think that's something to remember, because there are so many investors out there now. Like so many investors. The people that are at the very, very top, it might almost be a little bit of the best representation. I mean, because all the people that have just seen incredible returns, that have made just a boatload of money, have, of course, been people that have been highly concentrated and have picked winners. I mean, of course, that's the recipe to success. But on the same like page, the people on the exact opposite end of the spectrum are also the people that were not diversified and had very, very big bets, except they just bet on the wrong companies and they went completely bust. So there is, of course, you have to kind of remember that at the very top, all of these people will be like, no, diversification is stupid. Why would you do that?
Yeah.
Because of course, like, if you wanted to be the bet, like, how is Elon Musk the richest man in the world? Well, because he's made big bet after big bet after big bet.
Yeah.
And they've all, like, because he's at the top, they've just happened to, I mean, he's worked very hard and he's a very smart dude, but they've all been successful. He hasn't really had a major flop. So I think that's worth remembering there. The people that do collectively generally pretty well are diversified. The people at either end of the spectrum that either do really bad or really good make really concentrated bets.
Yeah, I mean, certainly, I mean, the richest people in the world, you can think of their bet in the same way as investors, really. They've spent their life and gone all in on one business. They just happen to be managing it, which obviously influences their success as well. But they're all going all in on an idea or whatever it is, or on a certain product. But yeah, I think that's certainly true, especially for watching people who have, because you're right, if you have a highly concentrated portfolio, of course there's going to be, especially over a shorter period of time, there's going to be people who have success with an element or a significant element of luck. So that's certainly gonna play a role, regardless of what your portfolio diversification is. That plays a role. But yeah, I think concentration, I guess, does add a significant amplifier to that, especially if it does really well. So
and I'm not a huge like diversification person. Like I'm not like, oh, let's own 100 stocks. Obviously, that's not me. I still think that you should have. Why would you put more money into the 10th best opportunity when you could just put more money into the best opportunity that you found? However, I'm not the kind of person that would be like 80% in one stock, I don't think. Yeah. Just to clarify things, like I'm not just saying diversification, whatever.
Yeah, I think I would probably let a stock go to 80%, I think, personally. Yeah. So if I'd put 20% of my portfolio into something and it became 80% because it did so well over time, I think I would be hesitant to sell any of that great company unless I felt that the stock had become insanely overvalued. But I guess, I don't know, because that hasn't happened yet. So we'll see what happens. But
we'll see.
I would like to think that I could just hold on to a great company. But I guess if it got to that percentage concentration, it would be difficult to justify leaving that much of your wealth up to one individual company. So
yeah, it'd make me sweat.
Yeah, I don't know if you'd be sleeping well at night.
Anyway, all right, let's wrap things up. Hey, what do you know? We still went for 58 minutes after all that. So there you go. We thought this was going to be a short one, but no, I don't know. Were we just fluffing?
There was a lot of fluff in there.
a lot of Hamish and Brandon fluff. We just got talking. We always just get talking.
Yeah.
But anyway, I guess that's what this podcast is all about. It's pretty laid back, pretty informal.
So insightful, chat. Brandon. This podcast is all about talking. It's all about talking.
Who would have thought? Quote me on that one. Yeah, who would have thought a podcast is all about talking?
That's our new tagline, I think. This podcast is all about talking.
It's all about talking. We're just talking this, talking that. Anyway, guys, let's wrap things up. Thanks very much for listening, as always. If you are missing us on YouTube, make sure you go over and check us out because you can see our lovely faces. Hello. Mm-hmm. And yeah, I think that's we got through every single question today.
Yeah, we need more questions.
So we need more questions. So if you got a question, we don't care. It could be about anything. We don't care. There's no silly questions. If you're curious about something, just let us know. Head over to the YouTube version of the podcast. Drop us a comment in the most recent episode, and we will add your questions into the Google Doc and go through them. So yeah. With that said, guys, thank you very much for listening. Thanks, Hamish, for joining me, and Sharesight for sponsoring, as always. And we'll see you guys next week.
See you guys.